Hello, everyone, and welcome to Carta's virtual event, Policy Playbook, Navigating the Shifting VC Regulatory Landscape. My name is Anthony Cimino, and I lead the public policy team here at Carta. Thanks so much for joining for such an important webinar. The private market landscape is changing. As the market's growing and permeating more aspects of the economy, we're seeing increased regulatory scrutiny and rulemakings coming out of many of the agencies. And today, the SEC is adopting rules that will fundamentally impact not only how venture capital is regulated, but how the venture capital firms operate. So today we've got two experts to walk through this evolving landscape and what it means for the venture ecosystem and the venture funds. Let me first introduce Stacy Song, a partner at Cooley. Stacy counsels private funds on regulatory matters on a range of different issues, all the way from fund formation to their ongoing operation. She advises registered investment advisors as well as exempt investment advisors of all sizes on legal and compliance issues that arise from federal securities laws. Prior to becoming a partner at Cooley, she was a partner at Fried Frank, and before that, she's worked at the SEC as senior counsel in the private funds branch at the SEC's Division of Investment Management. Next, we've got my colleague at Carta, Holly Hiles-Pandel, who is a senior policy counsel related to capital markets. Prior to joining Carta, Holly worked as the head of legislative and intergovernment affairs at the SEC. And prior to that, she served as the senior counsel on the House Committee on Financial Services, working and leading aspects related to private markets. So we've got an incredible panel here today. And as I mentioned at the top, it's the right time to be talking about this because private market regulation is very much as an inflection point. We're seeing the impact of private markets into more segments of the economy, into more investors. And as a result, we're seeing increased regulatory scrutiny. And in many cases, that's going to have outsized effects on the operators, whether those are founders or funds in this space. And so, Holly, how did we get here? And can you give us a little bit more background as to what brought us to this stage and what's going to be coming next?
Yeah, so that is a great question. I think private markets play such a critical role in our economy, and we've really seen them increase and expand. The size of private markets grow over the past decade. Along with that increase in size, they're more complex. And given that breadth, policymakers are now viewing these markets with a little more scrutiny, not only just from the regulatory side, but also in Congress as well. I think, as you alluded to, the SEC has been the most aggressive with respect to private market regulation. Generally speaking, private markets, while they're regulated, it has been a much lighter touch than the retail-facing public markets. But we're starting to see proposals and rules come out of the SEC that are imposing more of those public-like disclosure requirements on private markets. Just a couple of examples of how some of these proposals are going to impact how fund managers operate. Not only is there going to be enhanced compliance and disclosure obligations, we're really seeing these rules alter the dynamics between, funds and their investors and funds and their portfolio companies. And along with these rulemaking proposals, we're seeing more and more scrutiny from an examination and enforcement perspective as well.
Yeah, can we stick with you just for a moment? You've talked about some of the broader trends we're seeing at the SEC on both the rulemaking and examination side. One manifestation of this in particular is a private fund advisor rule that came out of the SEC recently. Can you maybe give an overview of this to this audience as to what that rule includes?
Yeah, so I think the private fund advisor rules that the SEC adopted last August are probably the biggest shift that we've seen in policy that's impacting the private fund industry. So the SEC, in adopting these new rules, the goal was to bring greater efficiency and fairness to the markets through things like increasing transparency, reducing conflicts of interest, and trying to make private fund managers more accountable to their investors. These rules are a significant shift from the status quo, and they're not only going to impact how funds are regulated, but the operations as well. I like to generally think about these rules in two buckets. There's going to be new obligations that apply to private fund advisors who are registered with the SEC or RIAs. Those are going to include new quarterly statement requirements, which is going to require a prescriptive report to LPs with respect to fees, expenses, and performance. There's a new annual audit requirement. And for GP-led secondaries, there's going to be a requirement to get a fairness opinion or evaluation opinion in conjunction with those transactions. And then there's also new obligations that are going to apply to all private fund advisors. This is regardless of size or registration status. Everybody from that emerging VC manager up to your largest PE or hedge fund manager. These are largely going to focus around how preferential treatment or side letters are addressed. And now those terms are going to have to be disclosed to all investors. And for certain terms that have a material economic impact, those are going to have to be disclosed prior to any of investment. And then there's some disclosures around other fund activities as well.
It's really helpful as an overview, both as to what's going to relate to all private funds, as well as that smaller or more targeted swath of registered investment advisors. Stacey, if I can ask you, I mean, you're hearing directly from these firms and these advisors. What are you seeing as the biggest changes and compliance challenges that the industry is struggling with right now? Or maybe not struggling, but confronting?
Yeah. Especially for venture capital firms, right? Because most are exempt reporting advisors. I think the two rules that apply to exempt reporting advisors would be the preferential treatment rule and the restricted activities rule. But at least to date, from having spoken to venture capital firms, I think the restricted activities rule hasn't really raised too much of a concern. But the preferential treatment rule is definitely something that everyone's thinking about. And even now, as firms are fundraising, they're thinking through what the disclosure would look like and what sort of investor relations challenges they might face when that disclosure goes out. And so, just as a recap, there are two components to the preferential treatment rule. One is a flat prohibition on providing preferential liquidity or transparency regarding portfolio investments if doing so would have a material negative effect on other investors. And then the other is a disclosure requirement that has different delivery deadlines. And the first requirement, the prohibition on liquidity and transparency, would pick up not just investors in the fund, but also investors in similar pools of assets. So that would be like the feeder funds and the parallel funds. The similar pool of assets concept doesn't apply to the second requirement on the disclosure. Right, for venture capital firms, since the fund does not have redemption rights, as a general matter, the first requirement isn't too big of a challenge. There's no blanket exemption for closed-end funds, but the SEC did acknowledge that for closed-end funds, having more information about portfolio holdings likely would not result in material negative effects on other investors. But there are always this corner cases, so it needs to be a facts and circumstances determination. But as far as the disclosure goes, right, that's the bigger issue. Right, so all firms will need to disclose all preferential treatment given to investors in the same fund. And that's the case whether or not it's in writing, in formal side letters or emails or verbal. And material economic terms need to be disclosed to prospective investors prior to investing. And these are terms that the SEC has said, it's what a prospective investor would find most important, and that would significantly impact its bargaining position. So, fee breaks, cost of investing, co-investment rights are some of the examples that the SEC has given. And then all other terms need to be disclosed as soon as practicable following the end of the fundraising period. And then on an annual basis, if there are any new preferential treatments given to investors after the last written notice, then a new notice will need to be sent. So some of the questions that we're receiving nowadays, right? Does this rule apply to funds that are done with fundraising by the time compliance date rolls around? and and how does the disclosure look like, right? So it's sort of bad news, but everybody probably understands now by now is that yes, it does apply to all funds. And as far as the disclosure, firms can choose to show redacted copies of the side letters and sort of do like a data dump of redacted side letters. Or they can prepare a summary matrix, a lot like a master side letter, and provide that to investors. And I think which approach firms will choose will really depend on, the size of the firm, right? How many side letters they have, and those kinds of details.